We just have a quick question here in the chat asking about today's crude oil inventories number coming in with a very big draw of negative 7.1%, and why this draw isn't really seeing any upside in the oil markets at the moment. Now, I think this is a great question and a great opportunity for us to again stress the importance of why expectations going into an event is so critically important in assessing the potential outcome for an event. So, looking at crude oil inventories on its own it's useful, but it can get you in a lot of trouble because remember, apart from the EIA data that we get on a Wednesday normally, we the night before we always get the API data, which is the private inventories data. Now, according to the Energy Association, the API data normally consists of about 80% of the total crude oil inventory. So, whatever we get on a Tuesday in terms of private inventories is normally a very good barometer of what we will get in terms of the EIA data. So, just because the Reuters poll had it at an expectation of negative 0.7, that doesn't include the API data that we already had yesterday. So if we have a look at yesterday's API data in the terminal, this is just our daily opening news. Scrolling down to commodities, we can see that US private inventory crude stockpiles actually came in with a massive draw of negative 8.2 million. So going into today's crude oil inventories, the market already anticipated or expected a massive draw in terms of the crude oil inventories number. So the fact that it came in lower than negative, or higher rather than negative 8.2, is already more negative for the market's expectations in terms of what happened to API. And because there was already that expectation of a big draw, there wasn't really a lot of price action. We actually saw a little bit of downside in oil prices on the back of that. So looking at oil, in terms of the price moves yesterday, the actual move in terms of the API data happened yesterday and throughout today's session when the market actually traded into the expectation of that higher of that bigger draw versus the expectation. So it's just another quick example of why going into any event that you're trading, whether it's a central bank event, whether it is an economic data point, whether it's a political event, always make sure that you understand what are the expectations going into that event, because that will obviously show you how to trade it, and it can keep you out of a lot of bad trades as well, knowing how the market should and shouldn't react whenever we get the actual data and how that differs from the expectations.